you talk about the case for international, I'm curious where you're looking in particular and whether it's regional based or sector based, as you were just noting.
Look, it's a little bit of both. I mean, the US has done extraordinarily well, partly because it's had a very high exposure to the growth factor, principally dominated by technology, which has been the winning sector over the last decade. We still really like technology. We think that the dominant companies have been justified again in their dominance because of incredibly strong fundamentals. But we think that you've got better relative valuation opportunities outside geographically the US. And indeed, last year, rather quietly, the Eurostoxx 50 was slightly stronger than the S&P. Many people don't acknowledge that year to date, Europe has outperformed not just the S&P, but the NASDAQ. So has Japan. So it isn't that we don't like the US. It's gone up, it's done well, but there are geographical opportunities to diversify. And I think that means also broadening out from technology. We think technology is still going to be crucially important and do well. But as interest rates come down and we get this soft landing, the opportunity for broadening out into some more cyclical parts of the market is improving, but also into non-tech companies. We put together a list of what we call ETCs, ex-tech compounders. These are global companies outside of the tech sector, which have strong characteristics of reinvestment at a high rate, compounding high returns, and they tend to be somewhat cheaper and I think also offer good diversification opportunities.